Welcome to FinBot Insights, your go-to channel for breaking down complex financial topics into clear, actionable insights. Today, we're diving into the wild world of mortgage rates, why they're behaving the way they are, what's driving them, and what it all means for you. Buckle up because this is going to be an eye-opening ride. Let's start with the big picture. You might think that when the Federal Reserve cuts short-term interest rates, mortgage rates would just follow along and drop, right? Well, not so fast. Since the Fed began lowering rates on September 18, something surprising has happened. The 10-year Treasury yield, a key driver of 30-year fixed mortgage rates, has actually climbed, jumping from 3.7% to a high of 4.8% by January 13th. So, what gives? Here's the deal: 30-year mortgage rates are tightly linked to the U.S. 10-year Treasury yield. Why? Because the average homeowner holds their mortgage for about 12 years before refinancing, paying it off, or moving. That makes the 10-year yield a perfect benchmark. Typically, mortgage rates run about 180 basis points, or 1.8%, higher than the 10-year yield. For example, a 4.5% yield would usually mean a mortgage rate, around 6.3%. But here's where it gets interesting. This spread isn't set in stone. It can swing anywhere from 100 to 300 basis points, and lately, it's been on the high side, averaging a whopping 249 basis points over the past year. So, why is this spread so wide? It could signal that investors are nervous. Despite a strong economy, they might be worried about the sustainability of the current expansion or think Treasury yields are already high enough to make mortgage investments riskier. But here's a twist. While the mortgage market is flashing caution, corporate credit spreads, the premium on high-yield bonds over treasuries are at historic lows. It's like one market's shouting all clear, while the other's whispering watch out. Why the disconnect? It might mean markets expect any economic stress to hit residential real estate harder than other sectors. And there are some warning signs popping up. Credit card delinquency rates. They've soared to their highest levels since 2011. Yep, the same kind of spike we saw before the global financial crisis. Auto loan delinquencies are also at their highest since 2010. Mortgage and business loan defaults are still relatively low, but they're creeping up too. These trends could signal that credit spreads might widen soon, which would shake things up even more. Now, let's talk about what could bring those 10-year Treasury yields, and by extension, mortgage rates, down. It all boils down to supply and demand. Inflation expectations are the biggest player here. When inflation's high, fixed-rate bonds like treasuries lose their shine because repayments come in devalued dollars. Less demand for bonds means higher yields, especially when the U.S. Treasury needs to issue enough bonds to cover a projected 2025 debt service topping $1 trillion. Ouch. But there's hope for lower rates. A disinflationary environment, think productivity boosts or serious cuts in government spending, could reduce the supply of bonds and ease those yields down. It's a delicate balance, and we're all watching it closely. So, how can you navigate this uncertainty? Here's a pro tip. The CME Group has introduced mortgage rate futures, a new tool to hedge against the risks of a shifting rate environment. Whether you're managing mortgage servicing rights or pipeline risk, this could be a game changer. Want to dive deeper into why mortgage rates are staying stubbornly high despite Fed cuts? Check out the links in the description for more resources, and don't forget to like, subscribe, and hit that notification bell for more FinBot insights. Until next time, stay financially savvy.